So summarizing here what we've looked at in chapter 10, again, use these summaries. These are really useful as a revision aid when you come to, closer to your exam. Really good to kind of look at these tables and just kind of remind yourself of what's happening, test yourself on that knowledge. So in this chapter, we've looked specifically at disposals, and we've talked about the situation where control is retained. So we had a subsidiary, we still got a subsidiary, we've just sold some of the shares. And then we've looked at situations where control is lost. So full disposal, that is what we would see in your exam. And then just being mindful there that in the real world, we could also go from subsidiary to associate, partial disposal, or subsidiary to investment, partial disposal. So full disposal is what we're interested in for your exam. So we have looked at our group financial statements. So we've looked at our SPLOCI. So we've looked at consolidating, we've looked at time apportioning to the date of sale, we've looked at non-controlling interest to the date of sale. Nothing happens after that in the SPLOCI. In the statement of financial position, there's going to be no consolidation if our only subsidiary has been disposed of and we don't have any other ownership. We will see a consolidated statement of financial position if we do have other subsidiaries after that disposal. We looked at our group profit or loss on disposal, so fair value consideration received. We know that that is our cash coming in, and then we have to look at what is going out. So less our net assets, less our goodwill, and then our non-controlling interest there. So this is what's going to go into our consolidated statement of financial consolidated SPLOCI, and this is probably going to be shown as a material non-reoccurring item, which is going to be disclosed separately. But read your question. Just be careful, do we meet IFRS 5 or do we not meet IFRS 5? And then we've also looked at calculating the parent's profits in their own separate financial statements. So looking at the cash in, less the carrying amount of that investment. And we've also looked at how we reconcile the difference, how that occurs if we've got a lower profit on disposal to the parent's higher profit on disposal. And that's largely because the parent is recording that investment at cost. They're not making adjustments for the increase in the subsidiary's net assets.